The term dividend stock refers to shares of businesses that regularly distribute profits to their shareholders, most often in the form of cash. The best dividend stocks can be fantastic strategies to build long-term wealth in addition to being valuable sources of income. Nevertheless, not all dividend stocks make for excellent investments, and many buyers are unsure of where to begin. In light of this, we have compiled a list of dividend-paying stocks as well as some of the key characteristics of the best dividend stocks. Hey, welcome to Stock Market Mate. Today we'll talk about the 8 best dividend stocks with the biggest growth potential in 2023. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Number 8. Sabra Healthcare. If your worries over inflation and how it will impact your investments are keeping you up at night, buying shares of companies that own and rent out healthcare facilities could be a ticket to sweeter dreams. Sabra Healthcare Rate is one such company, and its stock price gain of more than 8.6% year-to-date makes it look especially appealing, particularly in comparison to the S&P 500, which is down by more than 12% in 2022. The strongest reason to invest in Sabra Healthcare is that it's well-positioned to capture long-term growth from the ever-expanding senior care market. Sabra owns more than 440 properties that are leased by skilled nursing facilities, behavioral health clinics, and senior housing facilities. When its tenants pay rent, the rate collects it, and over the last 5 years, its revenue has increased by 131.1% to $580.2 million in the most recent quarter. Sabra cut its dividend from $0.45 to $0.30 a share in early 2020, when the pandemic began to take its toll on skilled nursing facilities. It has kept the dividend the same since then, and its current yield is about 8.7%. The company's AFFO payout ratio of 83% is slightly better than Omega's and certainly safe. The dividend stock is in a position to benefit from long-term growth and have shown the ability to increase funds from operations. In the meantime, it offers high-yield dividends with relatively little risk. Number 7. Church & Dwight Company Incorporated. Church & Dwight Company Incorporated is a New Jersey-based manufacturer of household, healthcare, and global consumer products. The company has been making consistent dividend payments for the past 121 years and has raised its payouts for 26 years in a row. This makes it one of the best dividend stocks on our list. As of November 25, the stock has a dividend yield of 1.33%. Argus upgraded Church & Dwight Company Incorporated to buy in November as the company is in the progress to resolve its supply chain and production issues. Moreover, the firm also appreciated the company's market share gains for its current valuations. In the third quarter of 2022, Church & Dwight Company Incorporated reported a 1% growth in its revenue at $1.32 billion. In the first 9 months of the year, the company generated $534 million in operating cash flow and had over $437.6 million in cash. Its total assets amounted to over $8.2 billion at the end of September. Church & Dwight Company Incorporated was a popular buy among hedge funds in Q3 2022, as 40 funds tracked by Insider Monkey owned stakes in the company, up from 32 in the previous quarter. The collective value of these stakes is over $1.28 billion. Number 6. Expeditors International of Washington. Expeditors International of Washington Incorporated provides logistics services in the United States and internationally. The company's services include consolidation or forwarding air and ocean freight, distribution management, vendor consolidation, cargo insurance, purchase order management, and customized logistics information. Currently, Expeditors International of Washington Incorporated's price-earnings ratio is 11.8. Expeditors International of Washington Incorporated's trailing 12-month revenue is $19 billion with an 8.4% profit margin. Year-over-year quarterly sales growth most recently was 1%. Analysts expect adjusted earnings to reach $8.925 per share for the current fiscal year. Expeditors International of Washington Incorporated currently has a 1.2% dividend yield. The overall outlook for the courier, postal, air freight, and land sub-industry over the next year is positive. COVID-19 has seen the implementation of e-commerce increase dramatically, giving substantial boosts to the volume handled by the freight and logistics industries. A large amount of the world's cargo travels in passenger flights, meaning courier, postal, air freight, and land sub-industry can increase their prices as the demand has strained the current supply capabilities. Number 5. Brown & Brown Incorporated. Brown & Brown Incorporated is a diversified insurance agency, wholesale brokerage, insurance programs, and service company. It markets and sells insurance products and services primarily in the property, casualty, and employee benefits areas. Its segments include Retail segment, which provides a broad range of insurance products and services to commercial, public, and quasi-public entities, and to professional and individual customers. As of December 13, 2022, Brown & Brown Incorporated had a $16.4 billion market capitalization, putting it in the 91st percentile of companies in the insurance, multi-line, and brokers industry. Currently, Brown & Brown Incorporated's price-earnings ratio is 26.6. Brown & Brown Incorporated's trailing 12-month revenue is $3.4 billion with an 18.1% profit margin. Year-over-year quarterly sales growth most recently was 20.4%. Analysts expect adjusted earnings to reach $2.249 per share for the current fiscal year. Brown & Brown Incorporated currently has a 0.8% dividend yield. Insurance brokers tend to continue strong in the aftermath of heavy worldwide losses, specifically from COVID-19. The scale to which the companies can continue is directly tied to the economic recovery from the pandemic, mainly the demand for brokering and consulting services. Many of the companies in the sub-industry rely on the revenues from their consulting services, which are expected to regain traction coming as economic activity ramps up past pre-pandemic levels. Many companies refrained from projects as cost savings measures this past year, something that is unlikely to happen again given the decline in infection rates and the increase in total population vaccinations. Margins for the industry are expected to increase over the historical levels, as many insurance companies are still employing cost savings measures to offset the losses suffered in 2020. Number 4. Albemarle. Albemarle is a global specialty chemicals company with leading positions in lithium, bromine, and refining catalysts. Albemarle supports companies in many of the world's largest and most critical industries, such as energy, electronics, and transportation. Sustainability is at the heart of its business activities as Albemarle actively pursues a sustainable approach to managing its diverse global footprint of world-class resources. This lithium stock is in a unique natural resource position, with derivatization capabilities and highly experienced and talented global teams. This combination allows Albemarle to execute an aggressive growth strategy for the business via collaborative customer relationships. As of 2020, Albemarle was the largest provider of lithium for electric vehicle batteries. Albemarle's full year 2022 outlook remains strong, and it can give promising growth next year too. Number 3. West Pharmaceutical Services. West is a trusted partner to the global pharmaceutical and biologics industry for its proven expertise in designing and manufacturing high-quality, technologically advanced integrated containment and delivery systems for medicines that improve patient health. As of October 27, 2021, West Pharmaceutical Services Incorporated had a $31.1 billion market capitalization, compared to the medical equipment, supplies and distribution median of $766 million. West Pharmaceutical Services Incorporated stock is up 48.6% in 2021, down 0.3% in the previous 5 trading days, and up 47.3% in the past year. Currently, West Pharmaceutical Services Incorporated's price-earnings ratio is 61.6. West Pharmaceutical Services Incorporated's trailing 12-month revenue is $2.5 billion, with a 20.6% profit margin. Year-over-year quarterly sales growth most recently was 37.3%. There has been an increase in demand for medical devices in recent years, largely driven by process innovations, emerging technology, and an aging population. With this, West might just bring out the best investment year for you. Number 2. Enterprise Products Partners LP. Enterprise Products Partners LP is an American midstream natural gas and crude oil pipeline company with headquarters in Houston, Texas. It acquired Gulf Terra in September 2004. The company ranked number 105 in the 2018 Fortune 500 list of the largest United States corporations by total revenue. Enterprise has a very impressive history of returning value to investors through distributions. It has increased its annual payment every year for 22 consecutive years. Since the distribution is probably what attracts most dividend investors to Enterprise, it makes sense to start with a payment. The yield is not just large, it is also well supported. In 2020, a very difficult year for companies in the energy sector, Enterprise covered its distribution with distributable cash flow by 1.6 times. Investors looking for a generous yield will likely be attracted to Enterprise Product Partners' fat 7.8% yield. That's a huge 5 times larger than what you would get from an S&P 500 index fund today. Number 1. General Mills Incorporated. General Mills Incorporated is a Minnesota-based multinational food processing company. Exane BNP Paribas initiated its coverage of the stock in November with an outperform rating and a $90 price target. The firm gave a positive view of the food processing companies, mentioning that they have broadly outperformed the broader market during downturns. On November 14, General Mills Incorporated declared a quarterly dividend of $0.54 per share in line with its previous dividend. The company has been making consistent dividend payments for the past 124 years, coming through as one of the best dividend stocks on our list. The stock's dividend yield on November 25 came in at 2.61%. Due to the company's strong dividend history, it's a viable investment for 2023. And that's about it for today's video. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!